Good morning, traders. It is Thursday, March the 3rd. Bear with me today. I'm still struggling with this terrible cold, and it's hard to speak loudly. But anyways, let's take a quick look at precious metals here. Here's the GLD, which is the gold price, and you can see we've had this strong run up. You can argue we've broken out of a falling channel. We've broken a couple significant pivot highs. We haven't broken a real standout key high like over here or over here. And until we really do that, that'll be the real sign that we've got true momentum because we've seen this kind of standout high like this one and this one and this one happen in the past. And of course, they've broken all kinds of internal highs, smaller ones, but the trend has still remained down. Now, the price action this time around is looking a little bit better, and I do feel as though the bottom here is in the precious metals market. The question is, are we going to get some type of pullback or not? And gold's been consolidating here, and gold loves to have these kind of shakeout plays where it consolidates here. Everything is starting to point to lower prices. We're going to see some type of fairly sharp pullback in metals. But what gold and silver like to do is squeeze up here and make one last big final high, one big spike here. Could last 1, 2, or 3 days, and then it gets totally slammed. It has done that more often than not. So that's kind of what we're waiting for. We're going to see what kind of move we get going forward here. I am more or less bearish short term for gold, but I am kind of feeling like we might get a little bit of a squeeze. If we don't get a squeeze to the upside, I think we might see a little bit of consolidation, a bearish one using shorter term charts that could point to lower prices, and we could play the downside and then eventually get long for long-term investment to the upside. Now, if we could jump down to the 10-minute chart here of GLD, I've been showing a lot of these price spikes that have been going on. And if you take a look, uh, this is just over the last week or so, we've had several price spikes where we had a price spike here. Typically, the market within 48 hours usually will fill most of that price action. It doesn't have to go perfect to the high. I think anything that fills more than 60, 70, 80% of that move is considered, well done. But more or less, we saw the next day, most of that price spike getting filled. We saw the market totally wash out here, and then we ended up seeing that price spike getting completely hammered or tagged again in full a couple days later. And then, of course, in that early morning or post trading session, we saw a spike to the downside. The very next day, came down, hit that side, and then not yesterday, the previous session, 2 sessions ago, we saw another spike high. Yesterday, price ran up, hit that level, and is now kind of consolidating there. Overall, these price spikes are kind of playing out all over the place. And I followed it with gold and the SPY for a long time. And if you take a look at GDX, you can see the price spike we had very similar to gold, a price spike to the upside. GDX yesterday continued to move up. It looked like it's set to gap up higher this morning. And overall, though, a huge move in favor. And look at the GDXJ, same thing. Got the price spike. Price had moved up here. Again, I only use price spikes that are post or pre-market. I don't use any price spikes that are intraday with volume. I just don't. They don't seem to play out, and usually you don't get them anyway, really, unless there's Fed news, and I don't really count Fed news spikes as anything significant. Take a look at Nugget again. All these ETFs are showing spikes. It's funny, they all show spikes at the same time, which goes to show there's some pretty big power behind it. And the reason why I've always used SPY is because SPY is one of the biggest, most traded ETFs, and huge hedge funds and institutions use it. So when it spikes and moves, there's a lot of weight behind it. So the fact that GDX, the gold miners, even these leveraged gold miners are showing spikes, it goes to show that there's something big and broad that's moving those markets. And take a look at this even. You can take a look at dust, which is the inverse, so it'll have a spike to the downside. And of course, price started to fill and pretty much filled up most of that price spike yesterday. So these spikes are really powerful, and I keep tossing them out there to share with everyone. They are more or less a day trade. We get them in overnight trading, and then the next morning you see that move happen fairly quickly in most cases. Some days it takes 2 or 3 days to play out, but it's pretty imminent, the move. Not something really I fire out to intraday trades to everyone. But if you are an intraday or momentum trader, That's why I'm putting them out here, so you can take them and run with them and try and squeeze some money out of the market. Overall, I think we're setting up for some good swing trades and some long-term global kind of financial global reset trades. We're going to see some major indexes in countries start to have major moves that are going to last a long time. So we're just waiting. The market is in limbo. The overall market in general is in limbo. We've been just watching a lot of this small chatter. These are just intraday chatters, and we're getting the market's kind of grinding itself out here. Once we get, I think this intermediate cycle to the upside in the SP 500. Let me just go to the daily chart. Once we start to see this top out over here, and we start to get some topping formation and exhaustion over the next couple weeks, then I think we'll be set for some massive inverse trade positions where we could see the market come down, test these lows, and most likely break them and continue to fall. And we can make a lot of money when this level breaks. If we get short somewhere up in this area, and we get down here, we're going to be deep in the money. When it breaks this level and we see another leg to the downside, it's going to be some huge money to be made. So we're getting to this position where long-term plays to get put on here with inverse ETFs could start being done depending on your situation. Of course, everybody's got a different size trading account, different time frames, so you kind of got to adjust to what is going to work for you. When we get to a level here where I think it's a good spot to put on some long-term inverse trades, then I'll be giving those out for the U.S. markets and in various global markets also. Let's just jump over to let's take a look at TLT, which is the bond fund. Overall, getting a nice three-wave correction, fairly bearish price action here. We've been talking about this, that we're going to see this kind of spike up, and then eventually we're going to see it consolidate until the equities market rolls over, which I think we got another month or so before we really see the equities market roll over, and then I think bonds will be off to the races. Taking a look at energies, natural gas made some new lows there yesterday, continues to kind of grind out. I talked about how it consolidated a little bit here, and it looks as though if it broke yesterday or closed down near the lows, which it did, then we're probably going to see it continue to expand and probably do something very similar to this, where you see price kind of technically we'd be like right here today, this bar, and it's kind of broken. It's broken the low. So overall, I think we could see it excuse me, pick up speed and move to the downside. Crude oil relatively flat on the session, trading up near these highs. It's gonna continue to struggle. We're at the 20-day moving average, and I do have an upward bias on crude oil, but again, we are at resistance. The trend is down, and any upward cycles and bias are going to be somewhat muted because there's still downward pressure. So even though we should see the cycle rebound and show some pretty good strength, there's a steady stream of bearishness in the market that really mutes any buying, and it's going to kind of linger and hold prices somewhat down. And that's the same with the stock market. Uh, we're getting a nice expansion in the stock market in general, but it should make for a lower high, and eventually we'll see things roll over. And I think we're close to seeing the U.S. dollar potentially break down in a big way, and we'll see commodities take off then. But I think we're going to continue to see things flounder for another month or two before things really, before the commodities market really kind of puts in a firm bottom and a little bit of a consolidation after the strong run that we've seen in gold and silver and oil before things kind of take off. Let's just take a quick look at a couple global ETFs here. This is the Canadian fund, and where I feel we're trading at with these are very similar to, you kind of get a big sell-off and then you get a new low, and this is three surges to a low here, but eventually you see the market make these minor new lows and a shakeout, and you get a nice impulse wave, and then things kind of cool down a bit, and you kind of get these squeezes to the upside, very even similar to over here, where the trend is down, but we've seen a nice move to the upside. Very similar to over here, you kind of get a couple lows, then the market runs up and kind of squeezes out, squeezes up, breaking some of these highs, just like over here, you break these highs. And I think we're in a very similar price action. This one actually looks like it actually has a little more bearishness to it. It's got nice kind of rising lows. You can argue where you want to draw these lines, but it's making a bit of a rising wedge. We're coming into resistance, and this could have a little blow off top. This type of pattern, a rising wedge, usually has a blow off top, meaning we see prices spike up. Gold and silver are notorious for this. Everybody gets long, all the shorts get shaken out, and then you see the market kind of correct and then crash, and we see it go down to test the lows and make new lows. So overall, we got a bearish rising wedge in the Canadian market. And I think if you look at the price action, when you see these kind of rising wedges come up into resistance, we see it last a month and a half. This one lasted, a full month more or less before it really kind of started to break down. So we're up in there, the highs. I think we're about a month away from the market, the Canadian market and the U.S. markets from rolling over. Taking a look at emerging markets, the EEM, same type of thing. We've had basing pattern more or less, and then we've seen price run and squeeze to the upside, getting everyone kind of bullish. Same type of thing here. We're kind of squeezing up, and I feel as though we're like, right near this early phase of a top, just like kind of over here. And that's kind of where we're at. We're seeing the market here. Emerging markets are already starting to squeeze and have that kind of blow off top, starting to run up. We're going to have some key resistance right through the heart here at 33, and then some earlier resistance down here at 32. We got this gap fill, and of course a couple significant pivot lows over here. So overall, the market's getting up to resistance, and we're going to see some weakness, I think. It's going to be choppiness. We're going to see choppiness market for a month or so as it tries to top out, and then when it starts to break down, that'll be the key opportunity. Last market here, take a look at China real quick. Very similar type of price action, strong downtrend, and of course we've broken this little bit of a inverse, you can argue here, a little inverse head and shoulders formation. And there's potential for China here too. You can see the breakdown zone for China is more or less up here. So there's some room here for this little inverse head and shoulders pattern. The way to measure it, really simple. From the neckline down to the head, you take that, measure that to the upside. That's typically the energy that we'll have to the upside. Of course, so we got to move up here, and it happens to be right into resistance. You can see the high volume resistance right up here, so potentially a little bit higher. But really simple analysis, and it goes to show we still have some time for these markets to all do their thing. Some of them are going to continue to rise, probably like China. Other ones like the US market, Canadian market, I think are already at resistance. I think they're going to start to stall out more and trade sideways while some of these markets catch up. Eventually, all these markets will be kind of hanging over a cliff together. Some will be just a spike up, others will be hanging for a while, but then they all move down. And of course, I want to touch on one thing. Got a lot of members and subscribers asking me to cover the NASDAQ, the Russell 2000, the Dow. But keep in mind, they're the US markets. On a day when when the stock market is rising, they are all rising. You sometimes have a one-off day where the Nasdaq might be outperforming or underperforming, or the Dow or the Russell 2000, but 99% of the time, when the stock market is up, all the indexes are up. They all pretty much top and bottom at the same day, give or take one day. So it really doesn't make much of a difference which one I cover. I like the SP 500. It's a broad basket. It's bigger than the Dow. It's where the big money goes, mutual funds, so I follow it. But of course, if we have a signal or a spike in the SPY, you can trade futures SPY, you could trade futures NASDAQ, Russell 2000, they're all the same. So don't worry about if I'm not covering the index you want. The broad market timing is the same. It's a tide. When the tide goes up, pretty much all the boats go up with it. And then one other quick thing I wanted to touch on. A lot of traders are trading, our majority of traders, I was checking a survey I did last year with subscribers and followers. Majority of traders were trading they like the 60-minute chart. The 60-minute chart is great, but there are a couple problems with the 60-minute chart. 60-minute chart, you end up with two half bars. The market starts at 9:30, which means that first bar is only half an hour long, so that one bar doesn't represent full strength and real power of that 1 hour. And then of course the market closes. You have that one half an hour bar. So you do have one bar that is off every day. If you use the 30-minute bar, it's the clear representative. Every bar has the same strength. And I think that's kind of key. And of course, you get cleaner movements, I think, with the 30-minute chart overall, just because you get clean movements and you see breakouts. So, if you can migrate to the 30-minute chart, I would do that. I never look at the 60-minute chart, to be honest. I'm always 30-minute. The day has to be divided fairly evenly in terms of hours. Once you get into the longer time frames, like 240-minute, it doesn't matter so much. But overall, when you get into the shorter stuff, I think the 30-minute is much more powerful than the 60, just because every bar is now equally weighted. Anyways, that's it for now. Take care. Bye bye.